Well, I'm glad that it's Friday, but I don't know if I'm glad that next week's the election. So, given that who knows how the hell it's going to all play out, this will be a good conversation with Chris Brown, who I've gotten to know a little bit over the last year or so. Not just on X, but just because we're both in the industry, both know what it's like to manage funds, and both have some interesting ways of thinking about things. So, for those that are watching this live, whether you're on X, YouTube, or LinkedIn, I can see your posts, I can see your comments. First of all, do me a favor and repost this live stream. And if you want to ask a question during this conversation, put it on whatever platform you're on. I'll be able to see it. I'll bring it up. Let's make this as interactive as possible. So, with all that said, my name is Michael Guyed, publisher of the Lead Lager Board. Join me for the rough hours, Mr. Chris Brown. Chris, introduce yourself. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Yeah, sure thing. Current job, I'm currently the chief investment officer of a little firm called Democracy Investments. We've taken we've taken an ACWI XUS, which is an international market cap weighted index outside of the United States of developed and emerging market countries. And basically we tilt that using the Economist Democracy Index. So we take we overweight more democratic countries, Eurozone, Norway, Japan, Taiwan, and underweight more authoritarians, China, Russia, Saudi Arabia, all of that stuff. My background, been in the business for about 30 years, CFA like yourself, Michael. International Business School. I went to Thunderbird, now part of beautiful Arizona State. And have worked in fixed income equities, worked for a long time at Franklin Templeton doing multi-asset. So just a very, sort of broad and general background in markets, and have enjoyed your work and find, a kindred spirit out there.
I always find the idea of tilting towards democracies really interesting, because I think really the play there is more around rule of law.
Well, the whole aspect of it, you step back. When I was at business school, we were going into globalization was everything, right? The world was opening up. We had defeated communism, and if we just spread free trade everywhere, everybody would become more like us, and this would unleash, unbelievable prosperity. And 30 years down the road, it hasn't quite worked out that way. And we're back to, if not, I don't want to call it, maybe you could call it Cold War 2.0 or what have you, but there has been this separation, and that tide, which came in so big, is now starting to go out. And just from I try to look at it as, if I'd come to you in 1982 and said, Michael, you know what, I'm going to start a fund, and that fund is only going to buy 30-year zero treasuries and roll them for the next 40 years. You'd be like, that's silly, stupid. I mean, why am I going to pay you any money to do that? I can do it myself, yada, yada, yada. That would have outperformed the S&P 500. So to me, trying to capture these bigger cyclical trends, international is cheap. You're talking basically what 13, 14 times earnings versus the United States at 21. If you look at capital market expectations, all of that stuff. I mean, we can talk about timing and where markets are, but just from a value standpoint, you're getting a 2.7% dividend yield right now, roughly on that in that area. So there's just some compelling stuff that we see in all of that, and compounding all of those things sort of added up to, let's throw out something that is easily accessible, and just from an economic standpoint, then we can get into all the ancillary benefits that sort of fall out of that.
Is it that international is cheap, or is it that certain sectors are cheap that international tends to tilt more heavily towards? I mean, I get a sense that most of the overvaluation is largely due to tech, which is U.S. specific.
Correct. Well, some of it. I mean, certainly a large portion. I mean, a portion of it. But even if you're looking at an equal weighted S&P 5, I mean, you're still looking at what, 18, 16 to 18 times. So you're still getting international a lot cheaper. I think the divergence. I mean, and also an interesting play is for somebody who wants to go long the Democratic tilt and short the market cap weighted tilt, or short the inverse. Would be an interesting strategy. We launched our fund a little over 3 years ago, the ETF, and it went pretty well. It's gone pretty well for us. We've got about 350 to 400 basis points of outperformance since inception. It's narrowed a little bit with what had happened in Japan in August, and China's priming the pump now. But it's been pretty persistent, and we think that we're still in more of the earlier innings than we are the later innings of this cycle. These are things that sort of play themselves out over 5 to 10 years, and something that you can sort of put away as a core holding in your portfolio. I'd be interested in the discussion with you. The world feels like it's this mixture of the early 1970s and the early 1990s, right? You've got this whole deflationary theme over on one side, and then it feels awfully like the early World Wide Web 1992 internet on the other side. So I'd kick it over to you on sort of that piece there.
Somebody sent me a post, a reply saying everyone can look at the S&P, but nobody can, and say it's a bull market, but nobody can deny that there's a lot of weird conflicting dynamics that are happening, right? Like as we're chatting, things which are not going according to the playbook, maybe because it's some weird, to your point, Frankenstein of different time periods, or maybe because something legitimately is this time different, right? With AI, with NVIDIA, with small caps, with long duration yields, with debt. It's hard to really, I think, have too much confidence any which way, even though we have to have confidence in this business because we have to take actions with money. Let's continue along the international side. So you mentioned Japan. How much of Japan makes up the index, and then the fund? How important is Japan to the sort of overall performance?
Well, Japan is going to be important because it's going to be the largest country holding that we have in the portfolio. It represents the largest in any market cap weighted international index, and we overweight it. We're longer term. I mean, Japan has some challenges, but longer term we're bullish on it. It's been spike for as long as you and I have been in the business. The really biggest determining factor for us is the underweight to China. The democracy scores for China are 2.3, 2.2. If you could look to The Economist, and so that allows us to underweight it it just provides an elegant underweight by which nobody can go, hey, you're signaling us out, and/or you're going X, which it's in this business. There's sort of it's what to buy and then how much of it, and for a lot of investors, when you get exclusionary, okay, when do I get inclusionary again? What standard? At what point does it become a buy? So we wanted to just have something at least intellectually clean, where and also incentives. So I was talking earlier about some of the ancillary benefits around all of this. All of a sudden now, I like to say, come for the alpha, stay for the weapon, because once you start to build out products like these that have key tenets within them, folks have got to start to take notice, and it becomes an interesting you can do small things around the edges to improve your democracy score and improve capital flows, and that all of a sudden becomes both a rationale around money supporting countries that are more favorable to us, and really starting to move that piece, and then you get to the impact piece of it. We don't like to say the whole ESG stuff, but you get more democracy, more democratic stuff. Folks tend to vote things that they like, which tends to be more ESG stuff, and that's very personal. So all of these things we think are benefits of using this type of a methodology that can both make you money and provide the right incentives to help drive really positive change.
Let's talk about other countries. So it sounds like Japan ranks at the top. Is that am I thinking that correctly as far as sort of the most democratic?
So Norway, a lot of the
Okay, right, yeah, Nordic type.
the Nordic countries, Norway, Sweden, that type of thing are at the top. The United States is just below France. We're actually viewed by the economists as a slightly flawed democracy. Mostly around functioning of government is their criteria.
You're saying we don't have a functioning government? That seems to be.
It's been a little sketchy lately, but we'll see. We'll see where we can go from that. But yeah, and so like what this allows us, and some interesting stuff around the industry tilts that we have within our in the portfolio, because you were asking before about how if it's international, is it an industry thing? And you do see a little bit more financials, but like an interesting thing for is if you go through doing the democracy overlay doesn't really tilt you too much on an industry basis, other than, interestingly enough, moving you away from consumer discretionary, which I'm pretty good with, towards more materials. The one that I always thought that was interesting was, you would expect with the Middle East having such low scores that we would be underweight energy, but that energy allocation basically shifts from the Middle East to Norway and Canada. So we're basically flat on an energy basis. So all of this stuff, as we were doing all the back tests and everything like that, we were sort of coming out and it was just fascinating that things fell in the way that they sort of did from a sector allocation basis.
How does a country go from being highly ranked on the democracy side to not being highly ranked? I mean, I think a lot of people think about, okay, well, you go from non-democratic to democratic, but the pendulum swings, right? So how does that get measured again?
So the way that the Economist does it is they have a yearly numbers come out yearly, and they're basically in five factors around political effectiveness, participation, freedom of the press, and other civil liberties and other things. And it's a 1 to 10 score. And so there's 60 different dimensions on it, and it's been around since 2006. It's one of the most robust indices around this particular subject. There are other great ones out there. We just felt like this was be an appropriate one for us. We think we've got a great one, and we've got a great relationship with Joan Hoey over at the Economist, who calculates the index, so or compiles it, I should say. So it's an evolutionary process. It's not revolutionary in general, unless there's an actual revolution going on within those things. And they're just trying to track the paces of it. The challenge of it, if you go and look at it, is that levels of democracy have been declining, at least as the economists have been measuring it, over time. The world has been becoming more authoritarian. This year and this cycle, there are going to be more elections, I think, on the planet than at any other time in human history. And so we will see, and we're seeing how those things are playing out. But again, I think, like I said, we've got an interesting one coming up right now, and boy, I have my feelings, but I have no idea how this sucker is going to turn out.
Talk to me about the volatility link between countries that have more democracy versus those that don't. Meaning, do we typically see more volatility in authoritarian markets?
Well, yeah, because they're generally more news driven. I mean, it's always driven about what the government is coming out and saying. I do think well, first there's just going to be general volatility, as authoritarians tend to be a little bit more aggressive in foreign policy. But I think what my expectations is, and as another sort of toot of the horn for international, and back to that 70s analogy, is I think we're going to go back to where correlations are going to start to diverge a bit more between assets and between countries. Again, because everything sort of interest rates dropped, central bank stuff went to zero. Correlations among stock, we treated equities were just equities. I'm buying off the shelf generic equity, and I just think all of that is going to is going to shift, and I think you'll see greater, not just interesting performance, but greater diversification benefits from international.
I guess the question is, can that matter until, can that matter as long as tech is still the leader, right? So in my mind, everything kind of goes back to tech is the biggest differentiator between large caps, small caps, biggest differentiator between domestic, international. You need to have large cap momentum break for money to consider something else and break for some period of time. I mean, can you just get some organic interest in international in the absence of tech weakness?
It's hard. I think, yeah, I think you're going to need to see a retracement on the tech side. I think everybody, I mean, you tell me, everybody's having a hard time outside of that, chasing those chasing markets, or at least trying to raise assets, or doing those strategies. It's very hard. The challenge is right now, Qs haven't gone above 500 yet. We're still bouncing around off of that stuff, and so if it's a trader's market, you can play the volatility on the Qs and various tech plays, but I mean, until I'd see a breakout north of 500, I'd be wary. Maybe it can bounce through after the election. I don't know, but tech is, folks are paying a premium for growth because growth is challenging right now, and you tell me. I'm I'll make the value propositions are out there. But until they're realized, you tell me on it. It's been frustrating, has it not?
Yeah, no, of course. I mean, it's been wildly frustrating. First of all, I think it's underappreciated by those that are not in our business that this is probably the worst cycle you and I can be possibly dealing with, right? Even though. No, and I say it purposely because, and it's like, well, how could that be? The S&P is, the market's doing great. How could you not be doing great? Because even if your performance is in line with the S&P, you're not going to raise assets. Like I'm talking about from a fund perspective, from a business perspective,
yeah.
right? So I have a lot of fund issuers that are clients of mine, and everyone shares the same frustration, right? It's like, for there to be money flow into new strategies, into new funds, you need volatility, you need advisors, you need allocators, you need individuals to say, you know what, I should consider something else aside from SPY or the Qs. So it is it actually is a very brutal cycle, I think, for the industry, right? From a flow perspective, unless you're Vanguard and BlackRock, in which case, we know that they are the only ones that really get the flows.
Well, and it's not a complaining piece. It's just a challenge. I think tech has performed well, and it's very hard. If as managers, I think a lot of them are chasing. Have had to chase it. You can't not hold it at this particular point. I think I don't know if you saw, the CFA Institute came out with their most recent manager surveys, and those are pretty telling. there will be a shakeup, as I think you've outlined. I think it's closer than further away, but there's enough out there to make it interesting, and enough landmines that are significant to make it interesting. I follow China quite a bit. I spend a lot of time on that, and that's going to be it'll be a slow moving car wreck until it's very fast. And I worry more about our ability to make sure that we do better, not if, but when things collapse over there, than we did with the Soviet Union. So those to me are sort of the bigger, longer term concerns around that kind of stuff.
If we get granular on the countryside, which countries are relatively the cheapest? So, meaning you just took the highest ranked democracies and looked at their valuations, which tend to look actually the most attractive?
Oh, well, China's attractive right now. And if you're just looking, on a pure valuation basis, you can't argue with that. But again, I just don't. I think there's a great reason for it, because they're almost bankrupt. They've spent so much money on infrastructure and tofu housing. I mean, and this is the challenge. A guy like Jim Chanos was raising these issues, 7-8 years ago, and it's taken this long to sort of work its way through the system because it's so big. I have a long family history in Venezuela. We're rich, unbelievably rich country. But the first Chavez coup d'etat was 92. He took control in 98, and they still haven't. That whole thing still hasn't collapsed yet. So Cuba hasn't collapsed yet. So, but again, I think we're seeing this bifurcation. India's expensive right now. We like it. It's rich, and the Eurozone is relatively inexpensive. We're a little cautious there. We're slightly overweight Eurozone, but they too have things that they need to sort of work through.
Where are we relative to history? Meaning, there's always these like charts of like international versus US, whether it's on a price ratio basis or valuation basis. I mean, is there some stat that's like, international markets are the cheapest in, I don't know how many decades relative to the US?
No, there's the best. It's really the Ed Yardeni's got a great chart, and I didn't know we could bring graphics. In terms of the differential between the S&P or U.S. markets and international, overall, like I said, it's been as wide as it's ever been. I mean, you look at it, you look at the chart, and basically, since the global financial crisis, the United States has been working at a premium ever since, and that premium has gotten progressively wider to the point where now we're at roughly 8 points of PE, that 21 to 12 to 13, 14 differential is as wide as it's ever been. I mean, it's insane. I mean, it's the differentials are insane. They've been wide. They've been getting wider. But you're basically buying international at 2/3 of what you're paying for the U.S. market right now. So doesn't mean it can't get cheaper, but for 2.7 dividend and you're buying $1 worth of earnings for 66 cents. Sounds pretty good to me.
How much of the hesitation you think is purely just due to currency concerns, right? I mean, the issue with international obviously is the currency component can be a big driver of earnings, of total return, right? As part of that calculation. Dollar's been strong really since 2011. Does that throw things off for the international case, or is that maybe an opportunity given how strong the dollar's been for so many years?
Yeah, I think it's I think it provides more of an opportunity in that space, just for the reasons that you offered, especially for the majors, because I don't think that that that's playing out anytime soon. For emerging market economies, that might be a bit of a problem, but I think that you will see some snapback around this. Um, Especially as the U.S. has to confront some pretty serious debt to GDP issues.
What else are you focusing on aside from the international valuation end of things, the democracy end of things? Obviously, we have the election coming up. I don't know if any of that's going to ultimately matter for markets, because markets seem to not care until they do, obviously. How much do maybe U.S. elections factor into international momentum or international perception?
Well, I think this election is going to be pretty important, because um, there's sort of definitely two camps and two different directions on this that are on the table, and I think that the outcomes from that are going to be pretty significant. Um, the world is dealing, as you know, with a huge debt problem, and the debt problem doesn't become a real problem until it becomes a liquidity problem. And so we've got to. There's a lot of stuff that's going to sort of need to get handled here, and I don't know. You and I have had these conversations. I can't tell you which landmine is going to go off. There are a bunch of them out there that will cause problems and create opportunities for us. And I just think I just think things are going to roll out a lot slower than folks have been putting on. And that's, I guess it's easier to say today than with the AI stuff. But to me, the whole AI thing feels more like 1992 with the World Wide Web, 1992, 94, when folks were really hyping it. And it was a bunch of web pages and people were sort of figuring it out. And that uptake just takes a bit longer. I think that there's tremendous the upside and opportunities that those technologies are going to be able to provide, I think, are going to be remarkable. But we're sort of bound by human adaptation, and the user interfaces are all going to change, and it's going to require human evolution really around it to see this all manifest. So it's all these things are going to it's the thinking fast and slow, the Danny Kahneman kind of stuff. The flashy sizzle stuff never seems to sort of materialize in the time frame that it does, but sort of the long drip haul, by the you look back over 5 to 10 years, and all of a sudden, oh wow, yeah, that kind of did come true. So sort of 2 years into it, it doesn't seem like you've made any progress, but after like 5 to 7, whoa, we did get there. Although we still don't have our jetpacks. I'm still waiting on the jetpack kind of thing. Pissed off about that.
I will not be posting on X on a jetpack. But I want to. So this is actually interesting. So let's go with this. I think this is maybe a disconnect in my brain. I agree with the international side. I've also agreed for several years. So I've been wrong on my timing. Obviously, it's still been a U.S. driven market. But let's say AI is going to be as big as it's being made out to be. You don't really have AI names in international markets, and if AI is the next sort of major growth driver, how can international markets compete unless they have some AI players? Now that could still be coming, granted. But
well, I don't.
That disconnect, yeah.
There's sort of two things, right? It's the what's the example with Coca-Cola, right? It was refrigeration and stuff like that was the determining technology around around and its ability to ship stuff. It's the ancillary benefits and knock-on benefits. Look, the Nvidias, the Facebooks, the Googles of the world, and the digital stuff, great, but things are still got to get made, and it's going to be folks. It's going to be the companies and folks that utilize the technology to such a way that it becomes more interesting. So I don't. I mean. I don't think that means that precludes anything outstanding happening on the internet. See, a rising tide lifts all boats, and when and technology is a great leveler of the playing field if it's distributed evenly. So I mean, I think the bigger question is with AI is beyond the Robert Scoble and the just the issues around ethics and all of those stuff and the various algorithms. But if you just deal with set those things aside, tremendous stuff. But I think it will be it has the power to be a transformative technology and will lift all different types of manufacturers and stuff in ways that we haven't been able to comprehend.
You mentioned your experience as a multi-asset manager. I wonder if being multi-asset ain't what it used to be, because things seemingly are more correlated than ever. Is there something to the idea that just the world has changed in terms of the way different asset classes interact with each other?
It's interest rates. Come on, it's free. It's that's you give money away, correlations go to zero or go to one. Sorry. Yeah, all of that I think is coming back. I've been in agreement with you on gold, metals, commodities. I think we're starting to head back to a time of dispersion. I think the whole thing with the Fed and some of the prints that we've had here over the last week and a half or so. Looking into November and lowering rates, it's interesting. So I'll just say that they've got a very, very hard balancing act in my humble opinion. But yeah, it'll be fun. Grab your popcorn, people.
That's another interesting question, I guess, how U.S. interest rates impact some of these international markets. I mean, obviously everything tends to track the U.S. Monetary side, right? But how important is interest rate movement to the international democracy thesis?
Well, it's pretty important. I mean, obviously, we'd like to see. Well, I'd like to see sort of stable, a stable rate environment that's non-inflationary, and I think we're probably operating a little bit below that. We've pulled a bunch of, I mean, all the debt that we've acquired does is pull future consumption into the present, and if you don't, if that consumption is not productive, you got a problem. And we're pulling a lot of that into the present, and the consumption hasn't been particularly productive. So I just think on interest rate differentials and stuff like that, the biggest one that concerns me is China. I think China is going to be is going to have to deal with their interest rate imbalances because they've been trying to protect their currency. And I think in that, again, they're going to have some real problems there.
Chris, for those who want to track more of your thoughts, more of your work, and maybe learn more about the fund, where would you point to?
Yeah, we're at democracyinvestments.com, www.democracyinvestments.com, and we're under the symbol DMCY.
As simple as it gets. By the way, great.
As simple as it gets.
Grab that. Yeah, exactly. And as far as you on X, I see you do quite a few posts as well.
Yes, I am Chris Brown, CFA is my handle on X.
CFA charter holder. You always got to put the charter holder after that that acronym, as you know. Appreciate everybody that watched here. I have another one of these conversations coming up literally in 10 minutes. So I'm going to just prepare for that. Hopefully, I'll see you all.
Hey, I really appreciate the time, Mike.
Yeah, thank you, Chris.
Very much.